OpenAI signed contracts last year for $1.4 trillion in spending. That's not projected, not aspirational, signed. In the same year, they made $13 billion in revenue, which means for every dollar walking in the front door, roughly 100 are walking out the back. Their own internal forecast says they'll lose $14 billion this year, $74 billion by 2028. And a few weeks ago, Wall Street decided OpenAI was worth $852 billion. Here's what I want to show you. Not the AI is overhyped take, not the AI will change everything take, just the actual structure, how the money is moving, who's putting it in, and who's on the hook if the music stops. Because the interesting thing isn't whether AI is real. Some of it clearly is. The interesting thing is the financing underneath it. And that structure looks less like a tech industry and more like something we've seen before, with a different name. Let's start with a number that gets thrown around a lot and rarely examined. Goldman Sachs estimates $539 billion will be spent on AI infrastructure this year alone. Morgan Stanley forecasts $3 trillion, with a T, between 2025 and 2028, half of it financed by private credit. Private credit means debt. It means the money being used to build these data centers isn't coming from profits. It's being borrowed, and whoever borrowed it has to pay it back, one way or another. So who's actually inside this machine? 4 layers. You need to see all 4. At the top is Nvidia, the chip maker, the picks and shovels company. The only player in this entire stack that is reliably, absurdly profitable. $4 trillion market cap, more than the entire stock market of Germany. Below Nvidia are the data center operators, CoreWeave, Oracle, Microsoft, Amazon. The ones building the physical warehouses full of chips. Most financed by debt. Oracle just got downgraded by Barclays because its data center project is pushing its credit rating toward junk. Below them are the model makers, OpenAI, Anthropic, Google's AI division. These are the companies people talk about when they say AI. They burn cash. OpenAI has a 33% gross margin, meaning 67 cents of every dollar in revenue goes straight to compute costs before they pay a single engineer, lawyer, or electricity bill. And below the model makers is a 4th layer, thousands of startups building apps on top of OpenAI and Anthropic. Most of these will not exist in 3 years. A single foundational model update can erase an entire product category overnight. That's already happened multiple times. Now here's where it gets interesting. In September, Nvidia announced they would invest up to $100 billion in OpenAI. OpenAI the next day announced they would use that money to buy Nvidia chips. I'll let that sit for a second. Nvidia is giving OpenAI money. OpenAI is giving that same money back to Nvidia. OpenAI's own CFO, Sarah Friar, said out loud in public that Nvidia's investment will go back to Nvidia in GPU purchases. That's not how normal investing works. That's a specific pattern. It has a name. It's called vendor financing. And in its extreme form, revenue round-tripping. Every major tech bubble in modern history had it. Lucent did it in the late 90s. They loaned money to their customers so their customers could buy Lucent equipment. On the books, it looked like explosive revenue growth. In reality, they were just moving their own cash around and booking the return trip as sales. When the telecom crash hit in 2000, Lucent's stock dropped 99%. Now look at the AI ecosystem. Nvidia invests in CoreWeave. CoreWeave buys billions of dollars of Nvidia chips. CoreWeave rents those chips to OpenAI. OpenAI pays Microsoft for cloud services. Microsoft invested $13 billion into OpenAI. When Microsoft disclosed last January that 45% of its $625 billion cloud backlog was tied to OpenAI, the stock dropped 12% in a single day. $440 billion of market cap gone. Because investors finally saw what was under the hood. The demand everyone was celebrating wasn't coming from a million new customers. It was coming from each other. And here's the uncomfortable part. Even the real demand isn't making the math work. An MIT study last year found that 95% of enterprise AI deployments generated zero return. That doesn't mean AI is fake. ChatGPT has 900 million weekly users. That's real. The question isn't whether anyone uses it. The question is whether it generates enough revenue at enough margin to justify $1.4 trillion in commitments. Sam Altman said out loud on stage that people would overinvest and lose money on AI. Jeff Bezos called it an industrial bubble. These are not the enemies of AI, these are the people running the industry. So if you're wondering why OpenAI just raised $122 billion, at a loss, with most of the money coming from companies that either sell OpenAI something or buy from OpenAI, this is why. The round isn't capital, it's runway. Just enough to stay alive long enough to hope the math works out before someone calls the loan. In every gold rush, the safest place to stand is next to the person selling shovels. Nvidia figured that out. Nvidia is the shovel seller. That's the one part of this story where the economics are sound. Everyone else in this picture is digging, and most of them are digging with shovels they haven't paid for yet. Shovels the shovel seller is financing on credit against a gold strike that hasn't been confirmed. You've been told for 2 years that this is the biggest technology revolution since the internet. Maybe it is. I genuinely don't know. But what I do know is that revolutionary technology and sound financial structure are two completely different things. The internet survived the dot-com crash. Amazon dropped 94% and came back. The technology was real. The financing on top of it wasn't. If AI follows that pattern, a lot of the companies you're hearing about right now will not exist in 5 years. The chips will keep working, the models will keep improving, the people who held the debt will lose. That's how these cycles end. So the next time someone tells you to invest in AI, ask them which layer they mean. Because AI isn't one thing. It's 4 layers stacked on top of each other, financed by each other, counting each other's dollars as revenue. One of those layers will be fine. The other 3 are holding shovels. If you want to understand how business actually works, not how it's sold to you, subscribe. Watch the previous breakdowns. I'll see you in the next one.